This video will guide you through how VisionWorks, our next-generation life planning software, can take your financial planning business to the highest level.
Thank you for your time today. Before we start, does anyone have any questions that they'd like to ask? Anything that you'd like to review? Okay. I thought today we would go through rental properties, and the reason for that is because this week I've had a number of occasions to review files with clients, and rental properties were involved. So I thought we should go through and see exactly how it is that they work. So I've got VisionWorks open here, and I've created a solution that I just called Q&A for today. And what I'm going to do, and I'm going to use Bill's tab actually, is I'm going to add for him a rental property. So rental properties are under other. You can see them here. They're also, of course, on the joint tab. And just as a reminder, you can create as many rental properties as you wish. There's absolutely no limitation. The other thing that I just want to remind you about is that if you're looking for an entry, where do I put in a rental property in a visually driven program such as VisionWorks, if you go to help, click help topics, and then go to contents, and the where do I find book, you've got to double click the index, and then you click R for rental property, and then scroll down, there's rental property. And so it tells you, go to other and then rental properties. So again, if we just go to other, we see rental property. So let's create one for Bill. And what I'm going to do is I'm going to make the purchase date 2013. So this happened 10 years ago. And you can see here, if we just use the default value, it was purchased for $300,000. And the tax value today is showing 282, but the net worth is showing 414. So we need to understand how these numbers are arrived at. And they're based on the depreciation rate we're using for the building, which if we go to building land details is 4%. This is pretty standard for buildings that are, just typical rental properties. I'll show you that in a minute. And then also we're using an appreciation rate on the building, which is just equal to inflation. So we're not saying the building itself is appreciating, in any real sense. And then the appreciation rate on land we're using, because this is located in Ontario, is the long-term rate of return for Ontario. So let's go back to building land details. When it comes to the class of building, what choice should be made? The default's 4%. And if you click help and click see also, you'll see here, select the building's class from the class list. And if you click class, you'll get an explanation. So class 4 buildings bought after 1987, including components such as wiring, plumbing, heating, and so on. And that would be compared to non-residential buildings, in other words, commercial buildings that were bought, before or after 2007, buildings bought before 1987. And so on. Not class 10, again, non-residential building, or class 6 non-residential buildings, and so on. So generally the types of buildings that would be used for rental properties would be class 4 buildings. So how does this work? Well, what we're doing is we're using the depreciation. So we're saying that of the original $300,000, the split between building and land is 80-20. So we've got a $240,000 building. And that 80-20 rule is fairly standard. And what's happening then is 4% depreciation is being applied from 2010, when the building was bought, to arrive at a current calculated UCC of the building of $162,000. What's also happening is that the building $240,000 is using that 2% rate of inflation or growth rate for the building. And therefore, we're saying that the building over the last 10 years is now worth $294,000. And then we're using the $60,000 cost of the land, applying that 6.8% long-term appreciation rate, and saying that the land is now worth $119,000. So we're taking the original cost and then we're multiplying by the appreciation rate on the building, the appreciation rate on the land, and then we're depreciating the building also at the 4% rate to arrive at calculated values. Now, the issue is, if we talk about the UCC of the building, the undepreciated capital cost, sometime in the last 10 years, the owners of the building could have gone in and, for example, renovated the kitchen or done other upgrades to the building. And those expenses would increase the UCC. So this is the calculated value on the basis of the original building, but not including things that have happened. We don't want to have clients, tell us all the changes that they made to the building that would have adjusted the UCC. So what we need to do is just get a copy of the previous year's tax return, because it will have the UCC of the building. And then we could go in and overwrite it and put in, whatever we think the value might now be. So I'm just going to put in $225,000. Similarly, the $240,000 appreciation rate applied on the building, the 2%, the building could be worth considerably more today. So we might say, well, the building is actually now worth $400,000. So we can go in and put in that number. And then similarly, we can also say, and we think the value of the land is now $200,000. So we can put in that number. And then what happens is that when we go back and we look at the building land details, we see that the current net worth is $600,000, and the value for tax purposes, which is the UCC of the building and the land, is $425,000. So that gives us the ability to overwrite the calculated values in order to arrive at what we think the value is today. And then on a go forward basis, because this is, of course, what we're interested in, what's the value of the building going to be either at death or beforehand when we go to sell it, then on a go forward basis, where we apply the appreciation rate on the building to that $400,000 and the appreciation rate on the land to the $200,000. Now, the other thing that I wanted to speak about is if we do something like a renovation. So actually what I'm going to do is I'm going to go to net cash, and I'm going to go out to 2030. We'll use that as kind of our benchmark. And if we drill into the sources and drill into rental properties, we can actually drill down and see the calculation. So the rent, which is $24,000 today, and it's being inflated at 2% per year, our inflation assumption. The gross rent in 2030 is $27,000. We've got property taxes, which are, and operating expenses, which are deductible, to give us net rental income of $18,000. And then on top of that, we're able to deduct the annual capital cost allowance amount to say that our taxable rental income is $12,000. So let's look at 2030. What we can now do, for example, is we can add something like a kitchen renovation, and we can indicate what percent of that renovation is actually going to be used to enhance the value of the building. So let's just say that we go out and we make this renovation in 2030 so we can see the capital cost allowance impact. Actually, let's make it 2029. and I'm going to make it $100,000. Now what we're able to do is we're able to say, well, we don't necessarily want to assume that all of the kitchen renovation is going to increase the value of the property. So let's just assume that we'll increase the value of the property by 75% of that value of the renovation. But the important thing to understand is that when we make that renovation, what also happens is that we have now changed the UCC of the building because we've added $100,000. And so now you can see we've got that additional claim on the building. Remember, it was 112,000, I think, inflated. So we can see that additional CCA claim. And if you go out and look at the following year, then you can see how it's being depreciated each year after that. So it's important to understand that when we do a renovation, for example, that we can indicate how much of that we're going to apply to the increase in the value of the property. And we'll look at the value of income assets in a moment. But by the same token, the amount we spend, which actually inflated was 112, is in turn used to calculate the UCC of the building and the capital cost allowance claim. So again, if we look at income assets and we drill into the income assets and the rental property, we can see, if we look at over time, that we're saying the value of the building was $859, and now we're going to make it $892. So we're not applying we made the renovation, I apologize, we made the renovation in 2029. So what we're saying is that the value of the building between 2028 and 2029 did not appreciate the full $100,000. If that were the case, then it would be up by 100,000. We're saying it appreciated just by the 75,000, and then on top of that, we have the normal appreciation of the building and the land, which is several percent. So that's why we get to the 859. And I just recalled that we had made that renovation in 2029. So I'm actually going to go back and look at the rental property CCA rate. So in 2028, before we made the renovation, the CCA claim was $7,300, and we spent about $5,000 on the $112,000 on the renovation, which at 4% would be a little over $4,000 of depreciation. But notice in 2029, it only increases by a couple of $1,000, and that's because of what's called the half-year rule. In the first year that you make an addition or anything that affects the capital cost allowance claim, you're only allowed to claim half of it in the first year. So the assumption is, you've done it at some point in the year, not January 1st. So it only goes up by 2,000, but then in the next year, 2030, you can see it's that extra two. It's that whole kind of $4,000 that was added on. So that's also being taken care of. So just want you to be aware that doing renovations and so on in the future, anything that affects the capital cost allowance claim is properly taken care of in the software. And then, of course, when we go in and do something like sell the building, so let's just do that in the middle of the year, in, let's say, 2035, then, of course, what happens is that we get the sale of the property, and we end up getting the CCA recapture over that period of time because we're selling it for more than the UCC, and we also get a CCA capital gain for the increase in the value over the original cost of the building. So that's all, of course, properly taken care of in the background. And I think all of this is very important because in today's world, we see so many people who have assumed rental properties that we need to be able to, properly model the client's circumstances. So does anybody else have any questions, anything you want to cover today? Okay, well, if that's the case, I'll wish you an enjoyable weekend, and thank you for your time.
Book a demo. We'd be happy to show you more of VisionWorks' incredible features.